Well, our next guest likes the large cap multinational names, and joining us now is Seth Setrakian, co-head of U.S. equities at First New York Securities. Seth, great to have you on Fast Forward. Welcome.
Thanks a lot.
So a lot of people can argue why stocks are cheap here, but it's picking the stocks, I think, that probably matters the most.
I think what's important right now over the near future is to really assess a barbell approach. And my view on the world is we're not heading into a recession. But even if we were, there's going to be certain sectors out there that are going to be very interesting because they've already discounted a recession in terms of where they're trading at. Certain sectors within the industrial space, airlines, autos, I think are more than discounting a normal recession. Not a 2008 liquidity-driven crisis, but a normal economic downturn. The interesting thing is I think this recession could have been avoided. We've caused it, and not necessarily we've caused it. We don't know yet. I think the data will come out that we may blip into a slight recession. It's really consumer-driven and confidence-driven. There's no confidence right now in policy out there. We need clarity, and until the consumers, A, and companies, B, have some sort of clarity and comfort in terms of what's coming down the road, we can adjust our budgets accordingly. And regarding CapEx, regarding expenditures on a personal level, we just don't know what we have in our pocket to spend because we don't know the state of the world and monetary and fiscal policy that's coming.
So broadly, though, you do like the larger cap names, the big multinational companies. Aren't they, in some ways, though, couldn't some argue that they're the ones that are going to be more tied to the impact of a recession?
I think certain sectors, certain companies out there, among the larger multi-caps, are pricing in a recession, and you're getting a dividend yield on certain of these companies, 3-4%, much better than treasuries. They have catalysts in the short term that I think are going to unlock shareholder value, be it spin-offs or new pipeline drugs coming to the market in the near future. Activist shareholders involved also, which in my opinion generally, as long as the value is there and the company doesn't blow up, it provides a floor.
Right. We've seen a lot from Carl Icahn, certainly. But let's talk about, I just want to dig down into some of the names before we run out of time, because you talk about sort of headline-driven or some news-driven activity. Talk about Pfizer. That's a stock that I think you like that's up today.
Pfizer's in the tape today. They received approval for one of their drugs. A lot of these, there's 2 to 3 drugs right now in the dogs of the Dow, for example, Merck, Johnson & Johnson, and Pfizer, all with dividend yields of 3 to 4%. They're cheap. They're buying back a lot of stock. They're supported by the dividend yield. However, investors tend to not shy away, but they're not exciting stocks. They need catalysts to drive them. Pfizer's also spinning off their animal health business. Their divestitures, that creates shareholder value. People want to see sound capital allocation, money being returned to the shareholders, either through dividends, special dividends, large buybacks. They just want to see more efficient allocation, and these stocks are cheap.
What about retail? This is a sector you don't like.
I think I relatively don't like retail relative to other areas tied to the consumer. I think a lot of retail stocks are still up 200 to 400% from their highs, from their lows in early 2009. And if in fact we are heading into a recession, I think those numbers can get cut dramatically. The companies are much more efficient from an inventory point of view. However, if the consumer does retrench, numbers and margins will go down drastically relative to autos, for example, which I think are already pricing in a recession.
What about real estate? We were talking about pending home sales. That was sort of the poor economic data that came out today was on home sales. And it's been a long time since we've had really a positive trend in housing. Does that impact any stocks? Does that impact your view at all?
It's an interesting sector. People have always been focused on gold as an inflation hedge. I think today I'd be much rather buying houses and housing-related stocks as an inflation hedge if you want an alternative to a dollar. And relatively speaking, I'd rather be buying something near a 7-8 year low than a 7-8 year high. I think housing stocks individually offer over the next several years or in the medium term much more upside relative to certain other areas such as real estate investment trusts. So
you like the home builders, let's say, or home improvement companies?
Relatively speaking, versus the REITs. I think the REITs are very tied to the CMBS financing market. If there's any freeze up, and we know what's going on in the world, and you're starting to see LIBOR spreads go a little nuts, not like 08, but there's warning signs out there. If there's any freeze up out there in the financing market, you can see a 20-30% correction fast in the index. I think housing stocks are bumping along the bottom. There's not much downside. You have to be selective and look at the balance sheets to make sure. Some will go bankrupt, but I think if you were to choose a basket of them and the individual names and plus home improvement related names, they'll way outperform.
And then, Seth, we have 10 seconds here. Just quickly, where do you think the S&P 500 ends the year?
Over 1,300. Well,
Over
we will have a
1,300.
very strong rally into the end of the year. It's going to frustrate a lot of money managers.
Okay, that's about another 100 points from here. Seth, thanks so much. We got to leave it there. Pleasure to have you here on
Anytime.
Fast Forward. That was Seth Setrakian of First New York Securities.